Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. I'm your host, Chris Tennent-Brown, and today I'm joined by Slade Robertson, Managing Director of Devon Funds. We've had a couple of unexpected lockdowns up here in Auckland, and that means it's been a while between podcasts. So today, Slade and I will be catching up on the big financial stories of the last few weeks, including recent interest rate adjustments, the state of the New Zealand share market, and of course the much-awaited rollout of the COVID vaccine. Hey Slade, well, welcome to the booth. We've met many times over coffees and or maybe a beer every now and then and debated the problems of the world, but I think this is the first time that we've met and we've been recorded and sat in a studio together.
Yeah, look, it's great to be here, Chris. So, really good to see you, and obviously a lot going on, which is, exciting, hopefully, for us, obviously, and hopefully for your listeners as well. Yeah,
a lot of the investors will be familiar with your name and with Devon as one of the managers that appears in our portfolios, and I just thought it was a great opportunity for us to get together and talk about what's been a pretty weird year so far. How have you been going in all the lockdowns?
Yeah, look, it's gone pretty well, actually. It was an amazing change, obviously, for everybody when we go back over the past 12 months. But it's been quite incredible. I think, technology clearly has enabled large parts of the world to essentially carry on life and business as much as normal as it possibly could, and very different to what it would have been, in the years past. So no, everything's gone pretty well for us. We've within our business, we're very fortunate. We've got some really talented people that have created systems and which have enabled us to essentially work as normal from home, and financial markets have been quite extraordinary during that period. So from that side of things, it's been I think in this job you every year is memorable for one reason or another, but I think the past 12 months has been quite extraordinary and one which has been challenging, and yet one which I've really enjoyed being part of. And how about you? You've been working remotely as well for large chunks of it.
Yeah, and us economists are known for being a bit reclusive sometimes, and I think half of the team's actually happier just sitting at home buried up to their elbows in a spreadsheet, crunching numbers. But I've missed a bit of the people contact, and I quite enjoying getting back into the office. So that I've liked that the lockdowns have been quite short. The main thing for me is that I felt sorry for all the events that they've disrupted. I wanted to go to the Napier Art Deco Festival, and that had to get cancelled. The America's Cup going on now is a lot smaller event, it feels, with the crowd limits and that sort of stuff. So that I've just sort of been really pleased with how much stuff we are doing compared to other parts of the world, but felt really sorry for some of the events that have got cancelled on not being quite what they would have normally been as someone working in the city these days.
Yeah, I think that's really fair, mate. I think one of the if I'm looking for a silver lining in everything that's gone on, it's been the fact that my kids, who are all teenage children, have had to be at home with mum and dad, which is a reasonably unique experience in recent times. But no, that's been wonderful. And but yeah, no, look, it does feel, it's really interesting, isn't it, how quickly the world seems to be repairing itself, and clearly we can have a chat about vaccines and around all those sorts of things and how they're contributing into the world that we operate in today. But it's a really wonderful sort of view into the way that humanity works. We are just desperate to be social animals, and as soon as the door is open for us to get back to a more normal existence and pattern of living, there's such an appetite for it, isn't there? And which is great.
Yeah. And speaking of vaccines, I have to confess that one of the conversations we had over a cup of coffee, probably when we got let out of the first lockdown around May, is you were saying, I think vaccines will really turn this thing around. And I said, they are years away, mate. This is going to take a long, long time. And you were certain that this would be one of the quickest turnarounds for vaccine, and that was a key part of the recovery. And you were right. Here we are a year pretty much to the month after we first started getting cases here, that we're now delivering vaccines here in New Zealand.
Yeah,
it's amazing turnaround.
Look, it is amazing, and it's if we went back to the very early stages in it, and I think you and I had this discussion at the time, I was quite cynical about the fact as to whether or not we would see a vaccine in the timeframes that some were talking, and that really came on the back of 2 decades of experience investing into the healthcare space, and just seeing how difficult it can be to determine and develop a vaccine which is effective and has been sufficiently trialled and regulated and essentially authorised for delivery. But the thing that I picked up reasonably quickly into the process was just how committed governments were, regulators were, how much money was flowing into the healthcare space in terms of developing this program. And we are really fortunate in what we do in that we get access to lots of amazing people and organisations around the world who are involved in this space. And just the more conversations we had, the more evident it became to me was that we were more likely than not to see some progress with it. And I think we clearly are in probably a better position than I thought we'd be at the time frame that we are in. But it really does feel like we have a platform to at least begin to make some steps towards normality again.
Yeah, and I feel a little bit the same, that the pace of recovery is stronger than I thought. And I've said many a time, it's, as an economist, we never like being wrong. We accept that we will be, hopefully not as often as we're right. But it's good being wrong when you're wrong about how quickly an economy can recover. It's just been better than we expected. And here we are. The unemployment rate is much lower than we expected. If we use just basic GDP as a measure, the economy's got back to the sort of size it was prior to the pandemic quicker than we thought. We've still got plenty of challenges, but it's a good situation. And thinking of things that have kept us busy this year, this big interest rate adjustment's been the thing for me. I've had to redo our reports and outlook for term deposits, redo our reports and outlook for mortgages, and people are just saying, well, where are these rates going to settle? We've gone from worried about a negative official cash rate last year to now talking about when might the Reserve Bank start raising interest rates. What's your take on that, and how's it impacting things at Devon?
Yeah, look, I think when I think about the past couple of months in markets, I think this issue that you're talking about in a New Zealand context is very relevant, but it's been really, so much of it's been driven by what we're seeing in terms of the repricing of interest rates offshore. And, the commentaries and the commitments we're seeing coming out of central banks in this part of the world and in places like the US is that they remain absolutely committed to maintaining a very supportive set of policies. And it doesn't appear as if we're likely to see any tightening of that in the short term anyway. But what we are seeing is we're seeing the steepening of this curve. And what that means is that we're seeing longer dated bonds such as the US 10-year treasuries have moved from trading at around, I think you'll know this better than I do, mate, but around 90 basis points at the end of 2020 to trading quite recently at around 1.6, which is a massive move. And that really, I really love watching the way in which interest rate markets do move and shift. And I heard it quite eloquently put the other day in that there are two essential stages to looking at it, and I've got sympathy for this. The first one is a reflective stage where you get interest rates moving in response to a recovering world. And so as the world gets better and we start to repair and activity begins to normalise, we also then see, in accordance with that, we see inflation expectations begin to pick up. And that's led a large part of this repricing up of these interest rates. And that's actually not a bad time for equities, though. That is, what you often find is you get a pretty strong positive correlation in the direction between equities moving higher at the same time that interest rates do. The second stage is one where it's more restrictive as opposed to being reflective. And that's when interest rates, the cost of capital becomes prohibitive to economic progress and growth. Now, we're miles away from that in my thinking. But what this has really catalysed from an investment perspective in the equity space has been a couple of really important things. You've got to be, if you're an investor now, you need to be really careful about owning businesses which have lots of debt. Now, that's something that you and I would talk about, and we have talked about it many times over the years, mate. But you are particularly vulnerable at a time when you're having to reprice large chunks of debt in a balance sheet when prices are going up. So that's reasonably obvious. Another sort of pool of equities that I'm just quite conscious of at the moment is those businesses where you've seen this big redirection of capital and investor flows away from the traditional income spots such as term deposits and bonds into high-yielding sort of equity securities. And that makes a lot of sense, but if those dividends that they're paying aren't growing in accordance with inflation and moving with the general sort of trend of the economy, then they get really challenged by a situation where interest rates start to move higher. And so that's a space you need to be careful of. We're really lucky in this part of the world that you've got just this massive swathe of really good dividend yield paying companies which can still grow. And so we spend a lot of time looking at that. And the final thing that's really happened as a consequence of it, Chris, is that it has catalysed this rotation away from growth companies, which often get sort of talked about in the same context as technology type businesses, back into value. And the reason this happens is that when you look at these growth companies, lots of the earnings and the cash flow that they promise they will pay you in due course are quite long dated in nature. Now, as investors, what we need to do is we need to try and price that today. And so the way that you do that is you take this sometimes far dated expectations and you try and bring it back using interest rates. Now, when those interest rates go up, there is quite a detrimental effect on the valuation of those businesses. And so you're seeing a lot of money rotating out of those sorts of businesses back into value. And when I talk about value, the sort of companies I'm referring to there are ones which are typically more economically sensitive, and so their fortunes are driven by the economic experience that we get in New Zealand, Australia, and further abroad. And they're also companies which traditionally are much easier to value in traditional, more conservative frameworks, and so again, that gives me a lot of comfort. It's what we do at Devon. We tend to play much more in that space because we are super conscious about capital protection as well. And I think some of the valuation metrics that get used for some of these high growth companies, they at times just look quite ludicrous, and there's a lot of risk involved in them. So you're getting this rotation out of those names back into these more traditional businesses, and I think there's a lot more capital protection implicit in that shift as well.
Yeah, it's pretty interesting, this whole interest rate thing, how it permeates through. I mean, as a starting point, interest is an expense for a business, so the lower it is, the better it is. But like you're saying, when we're doing cash flow modelling and having to use some sort of interest rate, it's tricky. I mean, I used to use the 10-year government bond when I was at university, but back then that was, I think, somewhere 7 or 8%. I'm sounding old now. And I did a bit of an update with one of the universities and asked, hey, what do you use? And they said, 10-year government bond. Well, what number? Because it's been anywhere between 0.5% and 2% just within the last 12 months. It's really hard when these interest rates have got so low and are moving around so much, and how many things they impact.
Yeah, look, I think you're absolutely right. And so what you're talking about there is interesting because it's that discounting effect back on these future cash flows. Other ways of thinking about valuation in markets are things traditionally people like to use, say, price to earnings ratio. And all that is doing is essentially taking the price of a stock or a market and dividing it by the earnings it generates over. And again, typically that is on the next 12 months of in front of you. And but part of the problem is we look at those today and we think the markets look so expensive. But one of the lessons that I've learned really since the end of the GFC is just the importance of always being super conscious around what your alternative use of capital is, and in the space that you and I operate in, it so often is just the interest rate / the bond yields that you can invest into as an alternative. And so when you start looking at valuations in a relative sense between the two different sort of asset classes, you get a much more favourable outcome with respect to looking at equities in a valuation framework as well.
Yeah, I remember my early days at ASB and getting involved with you guys in the New Zealand share market. We were putting together the direct selections, which was a pretty snazzy way of getting direct exposure into the New Zealand share market. And like today, when we thought about what it would return, we sort of thought, maybe 8 to 10%. Hopefully half of that through dividends, half through capital growth, and that sounded pretty good until I go out and try and sell it, and ASB's got a term deposit rate of 7%, and people go, why would I take that risk when I can get such a high return from taking next to no risk in a term deposit? Whereas with term deposits getting down to less than 1%, things like ASB securities, managed funds have got so busy, and people have accepted a higher level of risk to, say, buy a bunch of utilities and get maybe a 4 or 5% dividend stream. So there's a bit of a question mark over that now when people are going, where might interest rates settle? But I'm with you in thinking that we're a long, long way off things like short-term deposits, the official cash rate starting to rise. But this longer-term adjustment, although it's causing a bit of volatility, is a good thing in the sense that people are pricing in a better 10 years ahead of us and a slightly more normal 10 years ahead of us than what we worried about a little while ago. Now, if I look at that explains some of the adjustments too, but also if we look at which markets are going well and which are going poorly, the Dow, the S&P 500 in the States, they're only within a couple of % of their all-time highs, especially after the big bounce we saw just this week. But the Nasdaq's down around 10%, and so's our market. Is this also some thoughts about how COVID-19 may be less of a big deal in the future? How's this impacting segments of the share market? Yeah,
look, it's a really great question. I think when you talk about the Nasdaq versus, say, the Dow and the S&P, the Nasdaq is, I guess, the poster child for these growth type stocks we talked about earlier on. And so as you're getting this rotation out of growth back into your more traditional businesses and your valuation supported stocks, that is why you're seeing an underperformance coming in that space relative to the more traditional markets. A little different in New Zealand, and I think what we've seen in New Zealand recently is a really interesting way to try and explain it is to look at some of the more idiosyncratic factors which define this market in this part of the world. And I guess one of the key aspects about the uniqueness of New Zealand is that it is a really small market and it is very concentrated in certain sectors. And when you get one or two of the key stocks underperforming, it really does have quite a dramatic impact right across the market, which is really different to Australia and to the more developed Western markets that we see, where you can have thousands of companies trading on a market, and so whatever one of them does is quite irrelevant. What's been really interesting is in the last little while we've had the reporting season. So I'll just give you a bit of context there, just in terms of what we've been through. And the reporting season, we get it twice a year, and it's a wonderful time for us as investors because you get a really concentrated set of information coming through from the companies that we own, and the boards that run these businesses and the management teams as to how things are really going and how they see the next sort of 12 to 18 to 24 months for those businesses. So it's really great. And if I go back sort of 12 months ago for New Zealand and Australia, and we sat there on the precipice of this global pandemic and the outlook for corporates in this part of the world, and you would have seen this at the ASB, was so uncertain and so bleak, and it was defined by companies coming out and saying, we're going to withdraw earnings guidance, we are going to cut dividends, we are going to raise capital. And all of that made absolute sense at the time because, when you have so many sort of externalities going on which are potentially so negative, you do need as a business to take a conservative approach. But now with the wonderful gift of hindsight, we can look back and it appears as if that was a very conservative set of positioning taken by these companies because of what you've described before around just how strong the economic environment has actually been. And so where we've just got to in the past sort of 4 weeks has been this reporting season in Australasia. And, the outcome that we saw in Australia, and this is a long way of getting to answering your question around New Zealand, was that it's now being described as probably the best reporting season that we've had in the last 20 years. And, that is again because people went into it with expectations which were still set in this theme of uncertainty. Yeah, you wouldn't have picked that 12 months ago that would be saying that in early 2021, right? Totally, exactly right. And I think, the end result has been that we're seeing actual delivered earnings come in at around $4.8 billion in Australian more than what the analysts had expected. So a huge number, and a lot of that is because of the very strong revenue environment we've had off a strong economy. We've seen great cost management from management teams, pretty conservative capital positioning. And again, that actually has translated into massive uplifts coming through in dividend expectations, which have lifted in Australia by about 9.2% for the year ended June 21. Again, if you take that back into real numbers, it equals about $6.2 billion of potential capital coming back to Australian investors. But where that's really interesting for us is that, again, if you roll into New Zealand, we also had a really good reporting season. And so the majority of companies did a really good job, and yet the New Zealand market was down 7% during that reporting season. It was the second worst equity market performance that we've seen in the past 20 years during a reporting season. And so you ask the question, why has that happened? And it's not that value growth rotation, which has influenced the NASDAQ. What it is situations like Fisher & Paykel Healthcare. So, one of our very best companies. And it was a huge beneficiary of what we saw globally with respect to COVID. So
they just kept revising up their earnings outlook through the period, and because they were helping.
Yeah, mate, totally. And it's such a good business, and they were positioned well for it, and the quality of their product was in huge demand, and we saw both hardware and consumables and ventilation and oxygen therapy being demanded right around the world. And so that lifted, and the expectations that suddenly got built into a continuation of this for that business just continued to grow. Where we've got to now, clearly, from your earlier comments on the vaccines, is that we now live in a different world, and people are expecting, as we've seen, because we've seen, test cases such as Israel and the US, where once the vaccine begins to get rolled out, you see a massive decline in hospitalisations. All of a sudden, people are repricing back that stock. So that weighed heavily on the New Zealand market last month. A2 Milk had a pretty disappointing result. And, it's a business which you talk about the upgrades which have come through from Fisher & Paykel. Well, we've seen 3 downgrades from A2 Milk over the past 6 months. And again, that was one of the super darlings of this market in the years prior. And again, it was a consequence of COVID impacting their Daigou distribution channel, but that weighed on the market. And then the final one really was just a reallocation of capital away from some of the clean green energy stocks that we have in this part of the world. And that's been a really fascinating dynamic. That took hold of the New Zealand market at the back end of last year, where the world is becoming increasingly conscious about directing their capital flows into areas where there is a sustainability thesis and theme behind it. And we're really lucky in this part of the world. We have, albeit it's a small market, we have some wonderful businesses here. And a number of our generation and electricity businesses are very defined by having that renewable aspect to them. So we saw tons of money flow in. And then a number of those indexes now, which that funds flow was based upon, have come back to realise that they are now, major shareholders in these businesses, and they've gone back to address the way in which those indexes are being constructed around liquidity constraints.
Yeah, that was a pretty interesting development that was pretty unique. But in the other stock stories, it just sounds like standard sort of stuff that you'd expect. There's challenging times, there's good times, and there's businesses like Fisher & Paykel that can actually have amazing business conditions in a really challenging time. And so nothing's really changed on that front. But what was going on in the within the index and those electricity stocks was pretty interesting for a while there. So. Very interesting time for us, and one that we're getting a lot of questions about, and probably as many about that as we are about the interest rates, and grappling with explaining to people, hey, bond portfolios are going to be down if we're in a rising interest rate environment like this, but it's not because there's a credit event or something going wrong. It's just this sort of repricing that we see from time to time. Just happens so quickly. Yeah. Hey, now you were spot on with the vaccine as it's turned out, and I was way too conservative, but we keep on putting each other on the spot. So what's your pick for when we might see the borders start to open, and what are the companies that you talk with are thinking about that? Because that's obviously the missing ingredient for New Zealand at the moment.
Look, it's a great question. I know that Adrian Littlewood was presenting, who's the CEO at Auckland Airport, was presenting yesterday, and he obviously was asked the question, and he was hopeful that we would get some further clarity around that today. Look, I don't know. I think that you would certainly hope that over during the course of this year we will see progress with it. It feels like such a stop-start exercise to have gone through, from a New Zealander's perspective, we desperately want to make the progress here, and I know everybody's sort of aching to get some confidence behind the way in which they can conduct themselves with business and travel and family and everything else. From an equity market perspective, a lot of this stuff is becoming less and less relevant, because if we got to a position where we were to sit there and say it's in the next 3 months, and I was wrong by a month or 2 months or 3 months, it doesn't really matter. The value of shares is determined by much longer durations of existence and cash flow and earnings that they can generate beyond that time anyway. So it doesn't really matter. But I certainly we want to see it as soon as possible. And I think given the progress that we seem to be making with the Pfizer vaccine arriving here, then we would hope that we're in the right direction. But how about you? What are you saying?
Oh, yeah, I think from a personal perspective, it'd just be fantastic if it happens over the next 12 months. It feels like an awful long time since I've seen my poor old dad in Chicago. He's had his 2 doses now of the vaccine, and he hasn't had any problems. So we've had the family test case go through, and my partner Sanai's the same. She hasn't seen her parents up in Japan for 18 months. But when we're looking at our forecasts, it's the missing piece in the puzzle. We can't help but think there's going to be tough times for the hospitality sector, for aspects of travel and transport until the borders open. So, but hopefully we're in the 12 to 24 months with a decent amount of certainty because of the vaccine, and yeah, it's a case of how we do it. Every time we have a flare up, you sort of kick your expectations a bit further down the calendar, don't you?
Hey, and so what's it meant for your dad? Is he now living life in a much more normal way?
Yeah, so my dad's in his late 70s, and what it's meant is things like he hasn't. There's not too many restrictions in parts of America, particularly rural America, and but Dad's self-restricted. He reads and believes what he reads about the pandemic, and so he's just self-isolated. He's stopped going to the YMCA to go swimming every morning like he used to. He's stopped socialising with his friends apart from being on Zoom. So for him, this means that with confidence, he's just regaining his life. So it's like a spring for him. He just feels like, okay, the world's getting better. But it was pretty grim for him and his friends that were all doing the same thing over the winter. So I think it's a big change. It's interesting in Japan. There's a lot of stuff that doesn't seem to have changed too much, apart from the fact that Sanai and I can't go and visit the parents. And we thought about it. I don't know about your family. My family are big huggers and all of that sort of stuff, so the lack of contact wasn't a big deal. But when we see Sanai's parents, like, we bow, and they don't have a lot of hand-to-hand contact like we do. But they miss seeing us and we miss seeing them. But it seems to have been a bigger deal and something that Dad and his friends have worried more about in Chicago than Sanai's parents have worried about in Japan, which has interested me. And they've sort of carried on with their life. But they haven't had a fun winter either with lack of family visiting as well. So, well, hopefully it's sooner rather than later, and this vaccine rollout continues to be successful. So apart from that, hey, one of the things we haven't talked about, we talked about interest rates, we talked about the share market a little bit, but commodities, they're going nuts. Apart from being busy revising our interest rate outlook, we've just revised up our forecast for milk prices, but other commodities, oil, resources have gone up as well. How's that impacting your portfolios and your thoughts on the outlook for some of the big commodity stocks? Yeah,
look, it's been a fascinating part of the market. We're really fortunate where we are. We've got Tama Willis, who works with us and manages money for one of your portfolios, and is a very, very experienced guy in a range of areas, but in particular in the resource and commodity space, having worked overseas in that area for a long time. And he's caught it really well. And if you look back on the past 12 months, China really was the only major economy which didn't go into recession last year. And they navigated some of the earlier challenges around the virus in the way that they did. The government learnt some big lessons from having gone through situations such as the GFC and some of the different cycles that they've experienced in the past decade. And they were quite quick in terms of pumping liquidity and support into that system. And what you saw infrastructure was very, very strong. You saw property was strong. Exports were actually quite strong as people sat back in New Zealand and bought all sorts of things online. Domestic consumption in China wasn't that good, and largely that was probably a consequence of the COVID sort of impact as well. But all that taken together, what we had last year was a really strong environment from the biggest consumer of commodities in the world. So If you think about China, they consume 70% of the seaborne iron ore that we have. They consume 50% of the metals in the world and 15% of oil. So oil's a little less relevant, but certainly for the other two, they are the key determinant. And so you had a demand situation which was very, very strong, and we saw the price of iron ore, which is the most important thing for an Australian perspective, go very, very well. And even now we're still trading at around $170 a tonne, which is a very high price. And it wasn't just because of the demand. What we also saw was massive supply disruptions. So Vale, one of the larger iron ore producers, takes a lot of its production out of Brazil, and Brazil's a basket case with respect to COVID. And so we saw massive problems there. We also saw problems in production in Australia as well, through some poor management around drilling and excavation from some of the major suppliers there. So that's gone well for us, and we played the iron ore names really well. And if I look at, say, the Rio Tinto result recently, the numbers are just massive, and it produces around, they exceeded the dividend expectations by around 24%. There's no debt in these businesses now, so they are just cash machines. And so I think we've played that reasonably well. We have taken some profits in some of those names recently, just because when we look at that price for iron ore, it is, in our opinion, an unsustainable level. China currently produces around 1.1 billion tonnes of steel per annum, and the ratio between steel production and iron ore consumption into that process is around 1.6 million tonnes of iron ore to make 1 million tonnes of steel. So that's the framework that we think about this in. And I think that the environment from a demand perspective in China remains robust. But what I would say is that you have a government there which is super conscious about taking their foot off the accelerator before they end up with bubble situations occurring, especially in areas such as property. Oil's been interesting as well. So the oil price is up around $70 a barrel now. China's less of the driver here, and I guess that's also reflected in the way in which oil seems to have moved at a later stage than some of those other commodities have. So China consumes 15%. Rest of the world is the driver, and as we've seen the rest of the world begin to navigate their way through COVID and begin to emerge in terms of growth and normalisation of activity, you're seeing demand lift. So that's positive. You're also seeing OPEC's come out recently and sort of said, look, we'll take a wait and see approach. So they're not looking to make any changes there to try and drive the price down. And also what we've seen is a really challenging time for US shale producers. And they are at the margin, quite important in determining some of these outcomes. They haven't yet come back into the frame in terms of production. So, that environment still looks quite positive for oil. But, with all these things, we are super conscious around cycles. And so, you just have to be really aware of the fact that these things don't go in straight lines. But and how about you from a milk perspective? Where have you landed?
Yeah, well, we sort of started out a year ago warning farmers that they should brace for potentially a payout under $6 for the season that turned out to be paying over $7. And here we are for this current season thinking, yep, we're going to be well north of $7.50 as possible. And now we're starting to think, well, are we getting some signals that we're going to have a good following season as well? And we tend to think, we hope the milk price averages out around $7 over the long run. So to have gone from last year worrying about a sub $6 payout to be now pretty confident that we'll see a couple of years of comfortably north of $7 is really nice. So we'll be watching, particularly over the next couple of months. We just got that massive surprise last week when prices jumped up 20% in one auction. And being conservative economists, we tend to want to see a couple of pieces of evidence before we get too carried away. But that's really making us pretty upbeat about the outlook for the next year or two, which is good. And we're seeing strength in other areas as well. We're pretty upbeat about horticulture. But just like it's not linear. Some of the markets where we'd send meat to have been a little bit more concerning as they've still been struggling through these winter lockdowns. So it's not linear in our space that we're forecasting either. I wish it was just a nice even cross like those supply and demand graphs we drew at economics, but everything's happening at different paces. But obviously as a team we're pretty happy with the general direction that things are going and just wonder where things settle on some of the stuff like this step up we're seeing in interest rates at the moment. For me over the year ahead, I think the vaccine and just seeing where interest rates settle and start to get some views about, well, when might central banks actually want to start lifting cash rates? I think that's still a way away, but I think we'll be talking an awful lot about that over this year, as well as hoping for some overseas trips. What are you going to be looking at apart from the usual pouring through results and so forth over the year ahead? Yeah,
look. I think that this is a world which continues to recover. I think that we have, I think it's a really positive framework that we currently have for equities as an asset class. I think, and that's on the assumption that we don't get interest rates racing away, which I don't think that we do. So we have a world which is recovering. So the demand backdrop for the goods and services that the businesses that we own, continues to improve. You've got central banks which appear as if they're going to remain very accommodative with respect to the policy settings that they provide. I think that there is definitely valuation support for certain sectors and stocks within the market today, and some of these are really great businesses. So I think that the key for us now is to work on the assumption that the world continues to progress towards a more normal state, and I think there is further room to go with respect to that, and just to try and continue to manage the risk in portfolios by making sure that we don't overpay for anything, and that's something that we spend a lot of time doing, but that remains our focus.
Sounds like an interesting year that we've got ahead for us. So hey, it's just been fantastic talking with you, Slade. Thanks for coming in, and I'll look forward to checking back in on how some of our predictions go in 12 months' time.
Thanks very much, Chris. Always a pleasure.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.